The market is a roller coaster. It's exhilarating, terrifying, and always unpredictable. Today, as we navigate a sea of red, a single question echoes: what lies ahead? Is this the calm before the storm, or are we on the precipice of a V-shaped recovery? Tom Lee, a renowned investor and market strategist at Fundstrat Global, sees a picture painted with the vibrant hues of a bull market. Lee was recently on CNBC and pointed to historical data, noting that in early 2018, we had a similar spike in the VIX and a collapse in consumer confidence as well. Shortly thereafter, he pointed out that the market started to stage its recovery. I'll play you a clip of Tom Lee on the CNBC show, and after that I'll give you my reaction breakdown of what he said and also give you an in-depth analysis on the best tech stock to buy now before it soars this year. Hit the like button, let's get 1,000 likes on this one, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Today's video is sponsored by my good friends at Forecaster Terminal, the best stocks analysis software I use in finding these incredible stocks. More on that later. Let's hear what Tom Lee has to say.
So that was interesting to me, Tom Lee, as I bring you into this conversation, the head of research at Fundstrat and a CNBC contributor, because he's talking about animals in hibernation, not animals dying. It goes back to this idea of uncertainty around things like trade and tariff policy and the fact that as of right now, in the midst of that uncertainty, perhaps companies are sitting on their hands before they start to make any kind of future investments. So if that's the situation, how much does getting some sort of certainty now frame the investment thesis for how you position yourself moving forward?
I think that's exactly what's happening now, Morgan. First, in 2018, which Michael was talking about, the spike in the VIX or the collapse in investor sentiment or consumer confidence, that all happened around February 2018. So really that coincided with that first low that was made in 2018, and the market began to stage its recovery. I don't blame any business or investor for saying, look, there's so much uncertainty, I can't make a decision. I think that's why Rick Rieder's talking about animals in hibernation. But as we start to think about the second half of this year, first of all, we've already had the collapse in sentiment. We've seen $850 billion of cash raised over the past year on money market balances. And then in the second half, we're looking for possibly tax reform, which really propelled stocks in 2017. So I think that the odds of a V-shaped recovery in stocks that come after April 2 is just extremely high because we've already sequenced a lot of the panic that people saw in 2018. I think it's already taken place.
So what would you be buying right now?
Well, to us, I think Exhibit A for a V-shaped recovery is going to be Tesla because it's really been one of the most controversial stocks, and it's been caught in that sort of political maelstrom of Doge and Elon Musk's involvement in the White House. And I think it's already recovered more than 15%. But I think if Tesla is leading us into this bounce, that's a bull case for Mag 7 to be the group to own in the next few months.
So you like Mag 7, even though we've been talking about things like cash burn at Microsoft and all of the CapEx investments and worries about a bubble in AI spending?
Yeah, I mean, in some ways, it's been a self-amplifying downturn, right? Because we've been worried about AI as a bubble and the CoreWeave IPO at a time when we have tariff uncertainty. So I could see it as a very convenient reason why investors have actually avoided Mag 7, and it's been the group that kind of really led the downturn. But it is a cyclical trade, too, because I think once investor confidence returns and they're going to start to buy stocks, the Mag 7 are not only the best companies, but they're the most liquid, and they've really derated. On top of that, I think financials and industrials look attractive as well.
What do you think it takes to see that reversal in sentiment? And we talk so much about when sentiment gets negative enough, it becomes a contrarian buy signal. So if we're there now, then what are going to be the catalysts to start to shift that confidence again?
Well, I think the focus right now is on April 2. So I think the market has a lot of myopia around getting tariffs and tariff clarity. But we know that tariffs are just one part of the administration's goal. There is reducing regulatory cost, and then there is extending tax cuts. I think as investors start to think about that for the rest of the year, that gets them quite excited. And of course, I think we have a lot of what I would call spooled energy. Investors can't stay this bearish. The VIX can't stay this anxious. There is a lot of firepower and dry powder on the sidelines, and I think businesses can't stay cautious forever. I mean, once they know the ground rules, I think they're going to actually start making decisions.
All right, let's break down exactly what Tom Lee is saying. He covered a lot of ground, from market uncertainty to investment strategies, so let's go piece by piece. First, he dives right into the uncertainty surrounding trade and tariffs, which according to him has caused companies to essentially sit on their hands. That means they're holding off on big investment decisions because they don't know what the economic landscape will look like. And honestly, that's a fair point. When businesses don't have clarity on policies, especially ones that affect their bottom line, they tend to wait rather than risk making the wrong move. Now, Tom Lee connects this to what happened back in 2018. He brings up February 2018 when the market took a hit, investor sentiment collapsed, consumer confidence dipped, and we saw a spike in the VX, which, if you don't know, is a measure of market volatility. That whole period marked a low point for the markets, and it took some time for recovery to kick in. What's important here is the pattern he's pointing out. Businesses and investors react strongly to uncertainty, which causes a downturn. But once the dust settles and clarity returns, markets start to recover. And according to Lee, we might already be in the recovery phase, even if it doesn't feel like it yet. He mentioned something really interesting. $850 billion in cash has been raised in money market balances over the past year. That means a lot of investors have been sitting on the sidelines, holding on to their money rather than putting it into stocks. But the fact that so much cash is just waiting suggests that once confidence returns, we could see a massive wave of investment flow back into the market. That's what he calls a V-shaped recovery, a sharp bounce back after a downturn. Now here's where he makes a bold claim. He says Tesla is exhibit A for this V-shaped recovery, and this makes sense if you think about it. Tesla has been one of the most controversial stocks out there, caught in the middle of political drama, Elon Musk's antics, and market skepticism. But despite all that, it's already rebounded more than 15%. According to Lee, if Tesla is leading the charge, that's a strong, bullish sign for the broader market. And from there, he extends this logic to the Mag 7 stocks: Microsoft, Apple, Google, Alphabet, Amazon, Meta, Nvidia, and Tesla. He sees them as the key stocks to own in the next few months. A bold claim, but one. Now some people have been skeptical about the Mag 7, arguing that AI spending is a bubble, and that companies like Microsoft are burning through too much cash with their capital expenditures. But Lee pushes back against this. He makes an interesting observation. He calls this downturn self-amplifying. What he means is that fear has been feeding into itself. Investors are scared about tariffs, AI bubbles, and economic conditions, so they pull back. That leads to lower stock prices, which then reinforces the fear. But he argues that once confidence returns, the same dynamic can work in reverse. Investors start buying again, prices go up, and sentiment improves. In analysis. Then he points out another important factor: liquidity. The Mag 7 stocks aren't just top-tier companies, they're also some of the most liquid stocks in the market, meaning they can handle large amounts of trading without huge price swings. That makes them attractive when money starts flowing back into stocks. He also gives a nod to financials and industrials, suggesting that those sectors look appealing as well. Now the big question: what will actually trigger this reversal in sentiment? What's going to make investors stop being so cautious and start buying again? Lee thinks a major focus right now is April 2nd. That's when there could be more clarity on tariffs, which would remove a big chunk of uncertainty. But he also reminds us that tariffs are just one piece of the puzzle. The administration is also looking at reducing regulatory costs and extending tax cuts, both of which could excite investors and drive stock prices higher. Then he brings up a concept he calls spooled energy. He's basically saying there's only so long that investors can stay this bearish. The VIX, which tracks market anxiety, can't stay elevated forever. And all that cash sitting on the sidelines, it's not going to stay there indefinitely. Eventually, businesses will need to start making decisions again. Once they have a clearer picture of the economic landscape, they're going to deploy capital, make investments, and start driving the market forward again. So to sum it all up, Tom Lee is making the case that we're already past the worst of the downturn. The fear and uncertainty that caused so much panic in the market is already baked in. We've seen a massive buildup of cash on the sidelines, which means there's a lot of dry powder ready to be deployed. He sees Tesla as the leading indicator of a broader recovery, with the Mag 7 following suit. And as soon as investors get more clarity, especially around tariffs, regulations, and tax cuts, he expects sentiment to shift dramatically, leading to a sharp bounce in the market. Whether you agree or not, Tom Lee makes some solid and compelling points. What do you guys think? Are we due for a big market recovery, or is there still more downside ahead? Let me know in the comments below. Now let's talk about the stock pick of the day, Flex Limited, ticker symbol FLEX, a global leader in electronics manufacturing services. Flex Limited provides design, engineering, manufacturing, and supply chain services and solutions to original equipment manufacturers in Asia, the Americas, and Europe. It operates through three segments: Flex Agility Solutions, Flex Reliability Solutions, and Nextracker. The company provides cross-industry technologies, including human-machine interface, Internet of Things platforms, power, sensor fusion, and smart audio. It also offers integrated solar tracker and software solutions used in utility-scale and ground-mounted distributed generation solar projects. In addition, the company provides value-added design and engineering services, and systems assembly and manufacturing services that include enclosures, testing services, and materials procurement and inventory management services. Further, it offers chargers for smartphones and tablets, adapters for notebooks and gaming systems, power supplies for the server, storage and networking markets, and power solutions such as switchgear, busway, power distribution, modular power systems, and monitoring solutions and services. Flex Limited is making waves in the industry with a market cap of $12.71 billion and strong financial performance in 2024. The company generated $26.41 billion in revenue, with a net income of $1.01 billion. Its earnings per share stand at $2.40, and it trades at a P/E ratio of 13.83, making it a relatively attractive investment from a valuation standpoint. Beyond the numbers, Flex is making strategic moves to expand its capabilities. The company recently opened a new product introduction center near Boston, designed to support healthcare product development. This facility aims to accelerate market entry for new medical technologies, providing a scalable pathway for innovation in the healthcare sector. Given the rapid growth in medical technology and the increasing demand for advanced healthcare solutions, this move positions Flex as a key player in the space. On the ethical front, Flex has been recognized as one of the 2025 world's most ethical companies for the third consecutive year. Earning this title underscores the company's commitment to ethical business practices, which can enhance trust among investors, customers, and partners. In today's market, where corporate responsibility plays a bigger role than ever, this kind of recognition adds credibility to the company's long-term growth potential. Innovation is also at the core of Flex's latest moves. The company announced a major collaboration with Torque and NVIDIA, aimed at developing an AI platform for autonomous trucks. This partnership highlights Flex's involvement in the future of transportation, tapping into the booming AI and automotive sectors. As self-driving technology continues to evolve, companies that position themselves early in the game stand to benefit significantly. With strong financials, ethical leadership, and a focus on cutting-edge technology, Flex is shaping up to be a company worth watching. A detailed fundamental analysis of Flex indicates that the company operates in a competitive yet diversified sector with a robust global presence. Operational trends demonstrate steady turnover growth and improving earnings, supported by prudent management of profit margins, ROE, and the debt-equity structure. Valuation models suggest that the stock may be modestly undervalued, presenting an attractive risk-reward profile. Sound metrics from the Altman Z-score, Piotrowski score, and Beneish M score reinforce the financial solidity, while a resilient efficiency rating and a respectable competitive advantage, moat rating of 0.7, underscore its sustained operational strength. Continuous diversification in both turnover and geographic revenue streams, combined with constructive insider activity, further strengthen the overall investment case for Flex Limited. So, there you have it. Tom Lee's take on the stock market V-shaped recovery, and the best tech stock to buy now before it soars. Finding winning stocks can be challenging. That's where Forecaster comes in. Our cutting-edge platform uses artificial intelligence and machine learning to identify stocks poised for growth. Forecaster analyzes vast amounts of data, identifies trends, and provides you with actionable insights. Try it for free with my link in the description and use code Galore10 to get 10% off. Investing doesn't have to be a solitary endeavor. Join our Stocks Galore Patreon community and connect with like-minded individuals. Share your insights, learn from experienced investors, and gain access to exclusive content. Together, we can navigate the market and achieve our financial goals. Don't let fear hold you back. Embrace the opportunity, educate yourself, make informed decisions, and never stop learning. Your journey to financial freedom starts now. Don't forget to hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Until next time, good luck on your investing.